Traders, have you ever thought how to think like a quant or how to even have a data-driven mindset? That's what we're going to talk about here on this episode 13 of the Independent Quant podcast. I'm the founder and host of the podcast, Luis. I'm here to help traders turn their trading ideas into algorithmic trading strategies. Now, I'm a trader just like all of you, or aspiring traders like some of you that maybe have not traded yet. I am not a financial advisor. I am not a FINRA licensed professional. I am just a trader just like you all. This is all for educational purposes. Any trade you take is your own, and I make no recommendations for any type of platform or anything on this podcast. And lastly, this podcast is not sponsored by anyone. This is all run exclusively by me through the Independent Quant. How do we begin to think like a quant? And then what are we going to talk about here in this episode? So we're going to talk about what it means to think like a quant trader, the key principles for a data-driven mindset, and how to apply quantitative thinking, even if you don't know how to code. So what does it mean to be a quant trader? Let's jump into that first one. So there are 4 key characteristics for that. It's that data-driven decision-making, that every trade is based on historical analysis, probabilities, and statistical models. Now, you think that all trading would be that way. I've been systematically trading for the last almost 10 years at the time of the recording of this podcast episode, and it's systematic, it's rules-based, but I don't use a real historical analysis or probabilities. I do forward test and sim test a lot, but it's not really data-driven. And that's one of the big things that quant trading allows us to do, is be able to develop that mindset to have, okay, we're going to start with the data first. So let's make decisions with the data that's available to us. The second characteristic is one that shares in common with just something I just shared, which is systematic approach. That's not unique to quant trading, but it is a key characteristic of quant trading, is that just like I mentioned for the strategies that I've been using for the last 10 years, they're systematic. I do follow a process to them. Quant trading takes that one step further and removes a lot of our emotions and biases and just out of the equation. And you're having now a systematic approach that can be replicated by a computer. And that's a big, big difference especially for someone like me, that I'm not necessarily a discretionary trader, but you have been using systematic process for the last 10 years. So again, systematic approach, we're using predefined rules and algorithms to remove that emotional bias that we may have. The next one is also not unique to a quantitative trader, but it's a risk management focus. We, as quant traders, define our entry, exit, and position size before we start trading. Now, that's true of systematic traders as well. Like I said, that's my background. So a systematic approach and a risk management focus. I don't want to oversell quant trading. Those are basic characteristics that all traders should have, right? But the last one is unique to quantitative trading and algorithmic trading strategies, which is backtesting and optimization. So before applying a strategy, we test it rigorously with historical data. And that's something that, for example, I couldn't do with my systematic approach, at least not neatly, because yes, I'm a pattern trader. I can find those patterns, but that's always dependent on me being in front of the computer to have seen those patterns. So could I really backtest my strategy? Because I'm not always in front of the computer. I'm predominantly a swing trader, but the key characteristic of that quant trader is we can have the computer backtest and optimize a strategy, because we're never really going to be there to observe the trade, to either open it, close it, or position size it. So those are the 4 key characteristics of the quant trader. Again, that's data-driven decision-making. You don't make off-the-cuff decisions. You use statistics in your favor. You're systematic, use risk management, and you backtest and optimize all your strategies. So let's dive into that whole data-driven mindset. So a data-driven mindset, I love this one for quant trading because it's unique really to it, especially if we're compared to us that are systematically trading without a data-driven mindset, because it takes the place a lot of the psychology and emotion of trading, which for me as a systematic trader has always been a very key part of trading, is how am I feeling today? How am I thinking? How am I processing information? Am I in a condition to trade the markets today? Not really a concern that a quantitative trader needs to have. However, it doesn't completely go away, right? The psychology and emotion of trading remains, but it's lessened to a great degree if we develop this data-driven mindset. So that's really that first step, is just removing emotions from trading. And removing is a very strong word. I use it because that's a lot of what I find in the literature. I don't believe it removes it. I've been running algorithms now for almost as long as I've been trading live, which is about 7 years. And it never completely removes the emotion, because I want to check on the algorithm to see how it's doing. I want to check on everything that's running on my systems. So there is stress that remains, even though you may be using a data-driven approach, but it doesn't begin to compare with trading systematically or trading in front of the computer. For example, today, I was trading Euro USD, that's the euro dollar pair. And real simple, my trades are very much set and forget. I set a trade up roughly at 9 this morning or 9:30 this morning, and it took over an hour and a half for it to play out from entry all the way to hitting its target. And I tell you what, I'm not supposed to babysit my trades or look at them, but it was a slower day for me. So I would log in every now and again and check to see how it was doing. And that is, depending on how you trade with your quant style and your algorithm, you may not even have the option to do that. You may just be looking at a series of numbers on a spreadsheet or off a data feed. It's harder to become that emotionally committed to a trade, which is really what we want out of being as traders. We want a rule-based execution. We want to stick to a predefined strategy rules, regardless, even in volatile markets. If that's what you traded, if that's what you tested your strategy for, just let it run. And lastly, we accept small calculated losses as part of our long-term success. So that's where we need to arrive emotionally. It's all rooted on this next part, which is we want to focus on probabilities and not predictions. One of the best books, I believe, for trading, I was turned on to it by one of my first instructors when I first took on trading, is Trading in the Zone. It is phenomenal. It stresses to us that as traders, we need to develop a probabilistic mindset. And that's what I didn't have today, even though I've been trading for 10 years. Having a probabilistic mindset means at first that you have completely accepted that you don't know what's going to happen when you place a trade on. You may have a trading strategy that wins 80% of the time. Well, it still loses 20% of the time, right? So you can't focus on uh, the probabilities, because even that you don't know in the trade that you're in if that's going to be one of your 80% or one of your 20%. So just focus on your setups, focus on your rules, and success is going to come by stacking the probabilities in your favors, not by trying to predict what the market is going to do, what this single trade is going to do, what you need to do this specific time. No, those probabilities are going to play out given how you structured your strategy and how that's going to play out in the long run. Now, the next one is backtesting and historical validation. So we have our strategy. You've developed an idea. You've coded it out. You need to see if that's actually a valid strategy, a strategy that not just makes money. We don't just want strategies that make money. We want strategies that make money within the confines of a risk management plan. If you don't have a good risk management plan, you could be destroying your account. You may have huge winners, huge losers, and yeah, you may come out net positive, but it may not be sustainable for your account, and it may not be sustainable for your psychology, right? So before implementing any strategy, we want to backtest our strategies using historical data to assess how viable it is. We want to evaluate win rates, risk reward ratios, and drawdowns. I've got an entire podcast episode where I dive into the statistics that you should be looking at for just your backtest and evaluating a strategy. And you want to test across multiple time frames and market conditions. If the strategy only works on past data but fails in new conditions, it's probably overfit and unreliable. You want to be able to backtest, but you have to do it right. You can't just run a couple backtests, see a profitable number, and you're off to the races. No, there is a process to that. But once you get that down, I'd say that is the core of being able to begin to develop that data-driven mindset. Because once you have the backtesting and historical validation and you understand what your risk management, now you can start really get to appreciate how risk management is the priority. We are professional risk managers. Yes, we trade, but first and foremost, we are professional risk managers. We don't know what is going to happen now. So we need to understand, what's the survivability in the long run of our strategies and how do we manage our money and manage our risk to ensure that we don't blow up the account and we don't blow ourselves up. And the last one to developing that data-driven mindset is continuous optimization and adaptation, right? Markets evolve, they change over time. We're not always in a bull market. We're not always in a bear market. We're not always going sideways. A good concept of this, for those of you that are familiar, is Elliott wave theory. Elliott wave theory, at the core, what it's trying to communicate is that the market has impulses and corrections, and Elliott wave traders are looking for those impulse and corrections to try to exploit trading opportunities with that. But for this point, is that the market moves, it has these shifts and it evolves over time. So you can't completely just marry your strategy to the current market conditions, thinking that this is it. You're going to have to monitor the performance metrics of that strategy to make sure that it's performing per your standards and also that it's profitable for you. Because at the end of the day, yes, we are professional risk managers, but we're professional risk managers for a reason, which is we're looking for a return on our money, profit. When the market shifts and evolves, we want to be able to adjust our parameters to meet what's happening in the market right now. And we want to make sure that as the market evolves and we have multiple strategies out there, that these strategies remain uncorrelated to whatever degree you've become comfortable for your risk management plan. Because if those strategies all become very correlated or correlated to a certain degree, you're going to increase your risk, right? So we want uncorrelated strategies to reduce the risk. So now that we've got the core principles of a data-driven mindset, how do we apply quant thinking? Well, I'm going to give you a 5-step plan to get there. You don't need to be a programmer or statistician to pull this off. You just need to care enough to want to go through the process. The first step is define clear trading goals, right? You want to understand why you're trading in the first place. Are you trading for income? Are you trading for wealth? Are you trading just to be able to buy something in the near future? All of these things factor in to what your trading goals are, because then those trading goals will help us define our trading rules. Once you have your trading rules written out, what your entry, what your exit, and what your position size are, now you've got a metric to know how well you're performing off of those three. Are you getting in at the prices you want, getting out the prices that you should be getting out of? When you backtest, is that holding out along the whole spectrum of your trades? So it all starts with that step one. Define clear trading rules. The second one is use backtesting tools. We live in a great time. Each platform that a broker provides that allows algorithmic trading, which is becoming more the norm, is they use backtesting. They have a backtesting platform on them. I get a little more into this in my mini course. If you haven't signed up for that, it's free. Head on over to theindependentquant.com, sign up. You get to have a roughly 90-minute mini course where I even show what these backtesting tools are. I use NinjaTrader as an example. I talk on Thinkorswim. So you get to see a visual of this, but using backtesting tools is critical. And you don't have to be a whiz at this. A lot of these platforms already have it built in. TradingView has it, NinjaTrader has it, and TradeStation have it. So just become familiar with your platform and how to perform that. You can YouTube how to do it on your platform, but you can also even call your broker. Your broker is very interested in you trading money with them. So they will actually train you on or provide instruction. I don't know about training, but they'll provide instruction on how to do that. I know that when I signed up with TD Ameritrade, now they're owned by Charles Schwab now. This is now years and years ago. I switched to Thinkorswim, gave them a call about something with my account. the gentleman that was helping me technically was mentioned how they offer instruction on how to use Thinkorswim. And I remember to this day, it's probably been 6 years at this point, but they spent over an hour with me on the phone. They came on my computer and they just walked me through the platform, how to do different things on it. I'm sure that your broker may have a resource like that. Never forget that your broker has a vested interest in having you use their platform, because if you don't, you can go somewhere else. Now, if you are backtesting and you're a little more advanced, you're not tied to a broker, then you're using their broker software, you can go on and build a backtesting platform for yourself, or you can go on a tool like Quant Connect. Quant Connect is a paid service. I don't use it. I'm not advocating their use at all, but they do provide a platform for you to be able to backtest your strategies. You can do the whole suite of everything there. You can build, test, optimize, and you can even run your strategies off of their platform. So if you're not inclined to use your broker software for whatever reason that may be, there are resources out there where you don't have to build anything yourself. So now step 3, track performance with statistics. Okay. I've devoted one podcast episode to this, but the big 3, the first one being win rate percentage. This is the win one, the easy one. Everybody understands, hey, how often am I making money? That is a good start. I'll say that if this is one of your first videos with me and first time getting into trading, that's a decent start. Really where we want to end up in is looking at expectancy, not just win percentage. Refer to my podcast episode on statistics for that one. I go into a little more detail on it there, but we want to look at win percentage at the very beginning because it's easy to read. The next one is risk reward ratio. That looks at what your average profit is compared to your average loss and what the multiple of that is. And mind you, that's tied to that win percentage. So you can have a very high win percentage, but if your risk to reward is too low, you may not make any money, right? You can have a high win percentage and be not profitable. That is actually a thing. And the last one that I invite you to take a look at is the maximum drawdown. Take a look at those 3: win percentage, risk reward ratio, and maximum drawdown. I think those are a good place to start, but then always look to see what metrics are actually important for the strategy that you're trying to implement. There's going to change strategy to strategy, but those big 3 tend to be common regardless of what you're using. Now, step 4 is manage risk like a quant. So that means you're not going to risk any more than 2% of your account per trade. You're going to use stop loss based on some consistent metric that you're using, be that volatility or some type of price action. And you want to diversify across multiple uncorrelated strategies, which I've already kind of talked on. So managing risk. Like I said, we're professional risk managers. This is step 4. It should be step 1, but you can't do it before any of the other ones just because of the flow of this, right? But just because it's almost last on this list does not mean that it's any less important. This is what keeps you profitable in the long run. So managing your risk like a professional trader. I'm saying like a quant because this is what we are, right? This is the independent quant. But before I was a quant, I was a professional trader, and that goes with the metrics I just said. At the very least, don't ever risk more than 2% of your account. Much less than that. When I trade, it's no more than 1% of my account, but usually it's 0.5% of my account per trade that I'm risking. And the final step is actually kind of optional. It's not required to be a quant, but it's automate your strategy over time. So once you're comfortable with how your strategy is executing, you can let it run on its own. Well, I'm pretty much not fully unsupervised. I don't think that's ever wise, but with some alerts on there so that you know that you need to come check up on it, start getting into more semi-automated trading. I say it's optional because you can be a quant without having an automated strategy. It's all a bit about being data-driven. You can have an algorithm or a process that brings opportunities to you and then sorts the quality of those opportunities. And then you as the human choose which ones to trade. This can go so far as even staging the orders for you, but never sending them in. But it gives you at least the opportunity of going through each one, choosing which ones you want, and then either sending the order or creating the order yourself. That's one of the things that I seek to achieve. I'm predominantly a options trader. My options trading, I like it because it slows me down. I like how it helps me manage risk a lot better, but it's very intense for me to find opportunities and find just trades. And one of the first things that I seek to do as I build my algorithmic trade desk is automate that whole process of finding me good options opportunities, because I'm using a systematic process. So once I'm able to feed that to the computer, I'm looking to have that be expedited. So that's how we become a data-driven trader, right? We want to remove emotional biases. We want to make decisions based on probabilities. We want to use historical backtesting to validate our strategies. We always, always, always want to prioritize risk management. That is, again, what we are. We are professional risk managers, not just traders. And we want to optimize our strategies continuously as the market evolves. So you do all that, and you'll be on your way to developing a repeatable, disciplined approach to just being a trader. And I hope to see you all there. If you found value in this, head on over to the Independent Quant, sign up for our newsletter. This is, at the time of this recording, we're at the very beginning. Sharing my story as I build an algorithmic trade desk, but I'll have a lot of my lessons learned on there, a community for us to participate in. But give that some time as I build it up. Probably if you're watching this episode as it just got released, those things don't exist, but it's exciting for me because it's the journey that I'm on, and I'm really looking forward to building a community of people that are like-minded and pursuing the same goal. So look forward to seeing you next time at the next episode. This is Luis, everyone. Keep it green.